take us public, and then don't forget to record us once you take us public. Now we're live, so go ahead.
Okay, thank you. I would like to call this meeting of the Tax Review Commission to order. It's 12:01 on March 17th. So let's start with public testimony. We were provided a copy of testimony from the Grassroot Institute and also testimony from Don Ruslang about the film credit proposal. Any comment? Otherwise, we will accept that as provided to us. Next on the agenda is approval of the minutes of February 12th. Any corrections? If not, can I have a motion to accept the minutes as circulated?
I'll move for approval.
Okay, Kate, second.
I'll
Murray?
second. Yep.
All in favor, say aye.
Aye.
Aye. Okay, all approved. Thank you. So the next item on our agenda is commissioners' communications with stakeholders. And I noticed that, Alton, you had a couple of meetings. Do you want to just note who you spoke with?
Yeah, I spoke to Colbert Matsumoto, and we just kind of talked about a lot of the various state issues that he's been dealing with and aware of. And then I spoke to Joel Kent from the Grassroots Institute, and we pretty much discussed what you saw on that slideshow of his. So, that's pretty much it.
Okay, thank you. Anybody else? Okay, then let's move on to item number 5, the presentation. So Seth.
Let's see. All right, can you see the full screen?
Yes.
Okay.
Yes, we can.
Perfect. So today we're going to focus on, we'll do a little bit of the review of all the different tax types, right? So just to walk us through what we've done thus far. And so we did a presentation on all of the major tax types for that Hawaii and the state of Hawaii does, and even the local counties do, right? Which was the GET, the individual income tax, TAT, and property tax. Today's presentation is about bringing this all together a little bit and looking at who pays these taxes, right? Look, what are the distributional consequences of these taxes? And so that should give you some background. And then at the very end, I look at like the relative importance of growth versus tax revenues, or raising or lowering tax revenues. So again, some of this will be a review for you. However, I really encourage you guys to ask questions all the way through. This is the last of the kind of presentations, background presentations that we will be off, or that are scheduled. I'm happy to provide other informational briefings, things to you. This is kind of like the last time that we'll be doing this, and then you guys are going to take a much more proactive role in determining your agenda and things like this. So I just want to go back and think about taxation a little bit, right? I mean, we live in a market economy, and we usually assume that private actors are best at allocating capital, yet with taxation, we do not, right? So it's always really good. I think it's very good to identify our assumptions in terms of why we are engaging in taxation. And the more you can identify your assumptions and your goals, usually in my experience, the better you can formulate policy, right? So you know, there is a bunch of hubris in taxation, right? That's me saying somebody I don't know at all saying, I know how to spend your money better than you do. Right. And that's basically what we're doing with taxation. And, you know, just to give an example, is Bill Gates, one of the wealthiest individuals in the world, also one of the most active philanthropic people in the world. You know, you have to say, like, you know, people are debating this wealth tax, and a lot of the feeling is some people just shouldn't be, I don't know where the feeling is, right? But a lot of people say we should tax them, right? But like, you have to question, who's better at spending the money for prosperity? Is it Bill Gates or is it this rich person? Now that might change depending on who you think about in your mind. Like if you think about Paris Hilton, people's reactions may be different, right? But at the end of the day, what you're really doing with taxation is you're saying, no, these people, if we take money from you, invest it in this thing, there will be better, ideally, there would be a bit bigger impact than if you just spent it alone. And there's a lot of hubris involved, right? Because there's a lot of unknowns. So take example of Jeff Bezos, who's like investing in a lot of end of life research, right? So he's the richest man in the world. You know, like on my Twitter account, everything, I always see, oh, look at how much Jeff Bezos made last month, and shouldn't we give this all to people, or that should be taxed, right? Or nobody should make that money. But if you invested in a technology that expanded life expectancy for all people by 40 years, it's a really good return on investment, right? So the bottom line is, I don't know if that's true or that's not, but like when you are taking money away from people, you better know where to do it. And so the reason I have this slide up here is, one thing, at least with my work, I find people are much more interested in the taxation than what they do with the tax money, right? Because, so for example, this green fee that we're talking, or that's been passed around, a lot of people say, oh, you know, we need a green fee. People are utilizing our natural resources. We should tax tourists, things like that. And that makes, it's a totally, at least to me as a personal individual, like that makes sense to me, right? Like taxing for use. On the other hand, what are you going to use the money for? Not a lot of people, they say for the environment, but you know, as anybody who's lived in Hawaii knows, that the money doesn't always get spent the best way either. Tax money doesn't always get spent the best way possible, right? So we know this from rail is another great example. Rail, in theory, is I think of technology here in Honolulu is you know, we have infrastructure issues, and you do that and you say, okay, the rail does work, right? But in practice, it's a lot more harder to spend the money, right? So you guys are all investors, or a lot of you guys are investors, but spending money responsibly is a lot harder than raising money, in my experience. And so that's something to think about. And so what I did here is, you know, this is these are the equations that I just think of that's easy. Is the return on investment for, you know, what you're going to spend on money higher than taxation, the cost of taxation? If it is, then you should tax and spend the money reasonably. If it's not, and the return on investment is lower than the cost of taxation, you should lower taxes, right? Now, that's all fine in theory, but when you really think about the messy politics of the real world, the messy things, it's very difficult to know. And I also wanted to, I think it puts you guys in it's a very hard position for the Tax Review Commission, right? Because you really only have access to one side of this equation, which is the cost of taxation. Like, you do not know what, I mean, you guys can specify, but in terms of like how the money is being spent and what is being spent on, that's a harder thing. You know, that's usually part of the information that you need to decide when you're coming up with the appropriate tax revenue. So I just think about, when I think about taxation, I think about it in these ways. And, you know, there's just basically three questions. It's like, what are you going to pay for? So this is the return on investment side of it. Unfortunately, it's not the purview of the TRC, but I think it is useful to think about, what are your assumptions, right? Like, how is it going to be paid? What is it going to go to? And how is you're going to have, what is the cost benefit, or what is the benefit going to be? And then you have the, how much is the tax? So this is the tax rate. This is the purview of the TRC. And then a big one here is, what are your assumptions regarding behavior, right? So one of the things that taxation does is it affects economic behavior, and ideally you do it in a way that minimizes distortions in behavior. However, you know, like I can talk on this talk, I will talk about what we're doing with, and it's very difficult to figure out how behavior predict human behavior, right? And so that's one thing that we struggle a lot with in my office, is we get done to different tax proposals, and they want us to provide accurate estimates. However, to do that, we need to estimate human behavior, and we have to be pretty honest to say we don't know. And we have to have some you know, epistemologic humility here. And then who's going to pay, right? And this is also a purview of the TRC, but you know, what are your assumptions in terms of like who should pay? And a should is an interesting question here. And like, what is your regard to the different behaviors, right? So these are just questions I always ask myself, and I'm just trying to get it as simple as possible and to help you guys think about these issues that are confronting the commission. So today we're going to talk about who's paying the taxes, and I'm going to do this in two different ways. One, I'm going to look through residents versus non-residents, and the second, I'm going to look at by income distribution, right? So of course, non-residents don't vote, so it's the group that gets the most I see the most tax races for the people who vote the least. And so, but we do divide it up. And in reality, if you look at the instance of what non-residents versus residents pay, non-residents pay a large portion of our taxes, about 30%. This makes sense given that we're a tourist economy and a lot come in. So I just wanted to go through the major tax types and how that distributes between residents versus non-residents, right? So the GET is about 70% residents, 28% non-residents. Now, non-residents includes military and active military and their families, right? They don't pay state taxes, and they're not considered residents. Individual income tax, almost exclusively paid by residents, right? Corporate income tax is about half and half. The reason why this is so distributed is because most of the corporate income tax is paid by at least national companies or international companies. And most of those shareholders are actually, the capital owners are paid by are owned outside of the state of Hawaii. Transit and accommodation tax, mainly non-residents. And these are the other taxes, but they basically, like this is the alcohol, cigarette, fuel, public service utility. And so it's mainly borne by residents. At the local level, things change just a little bit. Again, the county surcharge should be the same as a GET because it's basically the same. The property I'll go down here to the property taxes, right? So residential, again, this is using deep ed studies, a number of different studies, but because, you know, some non-residents own property here, about 30% of property taxes are paid by non-residents. And then non-residential, it's much higher. And that's because non-residential are much, if you go back to our last presentation on property tax, you'll remember that the hotels and commercial property taxes are actually really high, or not really high, but high relative to residential property tax, right? And so commercial property taxes are much more likely to either be passed on to consumers in the case of hotels, which are mainly non-residents, and capital owners, right? And capital owners are, according to our assumptions, equally distributed amongst the United States relative to our economic size.
Steph, the PFM report, I believe, said that general excise and use taxes, they estimated, I think 19% were paid by non-residents.
So again, we have to be careful about what they say. If it's just visitors, according to GET, and I've done studies, and this is more or less about 22% 21% is paid by visitors, and the other 9% is active military. So with the PFM, I would go back and see if it's 19 or 20, then that's close enough for the visitors. But the higher rate is actually the active military, which is, you
That
know,
makes sense. Yeah.
1 out of 11 people in the state are either active military or associated with active military. So it's a large population, particularly here in Oahu, right?
Beth, can you remind me how you broke down the corporate income tax? I know you addressed it briefly, but is that going down to the shareholder level, or how are you figuring that split?
Yeah, so I'd have to go back and look at my assumptions, but generally corporate income tax, there's 3 people, you know, in a corporation. It's either labor, it's divided by labor, by capital owners, which is the shareholders, and in some cases the consumer, right? And so you divide it up between those. I think I looked at the current economic literature believes that corporate income tax is borne about 70% by shareholders and 30% by labor. So that's what I used. And like, if you're a shareholder, then I made certain assumptions about C corps versus partnerships. So most business entities in the state of Hawaii are local entities are actually S corps, right? And then the C corps, which are the larger businesses, and particularly the ones who pay the most amount of taxes, tend to be more multinational companies, in which case their shareholder, their, you know, the percentage of shareholder capital owners of that company is not concentrated in Hawaii. It's relative to the economic, I mean, basically we use 0.4% because that is basically the economic contribution of Hawaii to the state, to ownership of the United States. Does that make sense?
I think so. So does the corporate income tax include other things like payroll taxes and stuff too?
No, no, that would not be included in the payroll tax. Corporate income tax is just corporate income tax, the 6.8%.
So a company that's headquartered in a mainland state, but they have stores or something here in Hawaii pays no corporate income tax here.
They would pay in corporate income tax according to corporate income tax, people pay, there's a 3-factor model. So it's based on the amount of sales, the amount of employees, and the amount of assets you hold in Hawaii relative to everything else in the United States. And so you divide up your corporate income earnings according to that 3-factor model.
Okay, that's interesting. Thank you.
Mm-hmm. So basically what I'm saying here is we export. So in economic terms, we think of exporting taxes as taxes that are not borne by residents, right? And so one of the features of Hawaii is we actually, with our economy normally working, it's very different now that we don't, or when we don't have tourists. However, a lot of our taxes get exported. Now, they get exported in every single state. We just do it even more so, right? And that's because we tax a lot of our military and our visitors. And so when, you know, you look in the rankings, Hawaii, when you look at like tax to GDP or tax to total personal income in the rankings of states, you usually rank as a high tax state, right? In like the top 10 or something. However, if you adjust for residents, only resident taxes as a portion of total personal income, we move down into like the middle of the brackets. Now, does that really mean anything where you are within the United States? Not really, right? Because that doesn't tell you the other half of the equation, which is what are you getting for those taxes, right? And so part of, you know, you can live in some taxes with like, I think I think of Connecticut, right? Connecticut is a Democratic high tax state with generally known for good provision of goods and services, right? And so that's an example. Whereas you could also think of, you know, the extreme example is like a place like Alabama, or no, like Florida, right? Like they are consciously low tax state and they do not provide as many goods and services to their they're populous, right? So which state is better? I do not know, right? Even though Connecticut is higher up on the tax rating ratings and Florida is lower. It's just something to think about. Okay, so yeah.
So I have a question on your prior slide. Just, is part of the reason that we export such a percentage really due to our heavy reliance on GET?
Yes.
Okay.
Yes. That's the,
That's like it's not like we're really taxing them less. It's just we rely heavily on GET. You're here, you're going to pay GET. And so part of that is exported.
yeah. And then we have the TAT, which is not insignificant, right? And that's mainly paid for by residents. And then the property taxes that we do have is mainly either borne by the capital owners, which are not always concentrated in Hawaii, or the consumers themselves, which tend to be tourists.
Got it. Thank you.
Mm-hmm. Okay, so now we're going to look at like how things are distributed by income. I'm going to start off with a bunch of, well, I'll start off with this, right? So again, this is the breakdown of Hawaii's taxation Hawaii taxation for state and local governments, right? And so what you see is, you know, individual income in general, GET is the bulk of everything, right? In Hawaii, at least from the point of view of the TRC, you don't have control over this property tax. So it's really just whatever the tax incidence or the distributional impacts of GET and individual income is really going to drive the bulk of everything. However, it's really important to think about when you think about distribution and who pays Hawaii's taxes, it's very important to think about it in terms of the tax system as a whole, right? And why do we do that? One is GET, you know, is regressive, especially if we're just talking about on a year-to-year basis, right? However, our legislature has passed the, you know, the generalized excise and food tax credit to offset that, right? So what you really need to do when you look at a tax credit system is you look at the whole entire thing, not just one tax type in isolation. And that reveals much more about what's going on within the tax system. I'm going to go through this, and we're going to start with the individual income tax, and we're going to go over the GET, which you guys have, this will be a review for you. And then I'm going to go and put it all together. I'm going to take all of our taxes together and see who's really paying the taxes and for what. And then at the very end, I figured we can go over the ITEP tax report, because that seems to, it does not coincide with what the results I do here. And we're going to look under the hood. And so we're going to become tax specialists and really learn like why methodologically you can arrive at different results while people are still being, nobody's like making up numbers. It's just how you make up the numbers make a big impact on things, right? So again, you guys saw this, but you know, I just wanted to reiterate this because it's important to talk it's important to have a common language, and the common language is, you know, a regressive tax or tax structure is when the lower income people pay a higher percentage of their income taxes. Progressive tax structure is when higher income people pay a larger percentage of income taxes. Due to the nature of wealth concentration and wealth generation, even in regressive tax systems, higher income people will be paying more in taxes in absolute terms the whole time, right? That's just because they have more disposable income, they consume more, and that's what we tax. And so it's not you know, it's not who's paying more taxes in absolute dollars, it's who's paying taxes in absolute relative to their income. And now one of the big things is how we define income. And that'll come out as we look more and more at the different studies and things that go through. Which interesting is usually we care about income because it translates rough as a good proxy for consumption, right? But generally what we care about in terms of like government policy and human welfare is the ability to consume. And that is different from consumption. And a lot of like the percentages and the distortions that we see will often come down to this definition of income. So individual income, right? You saw this before. We have a progressive this is like the definition of a progressive tax structure. Lower income people pay less than higher income people. And one of the things about in Hawaii is we do offer some tax credits, refundable tax credits to people in the lower income spectrum, right? And so that even makes it more progressive.
Seth, I feel like I asked you this the last time, but I can't remember what you told me. What kind of tax credits do people at the upper end of the income spectrum get?
Yeah, the biggest one is they pay taxes to other states, right?
Oh,
So you get to write off, if you pay taxes in Hawaii and you're a resident of California, you don't have to pay, you can get a credit for those taxes paid. And these taxes in upper individual, these taxes up here, that's the most common credit taken. We've looked at this, it's very hard for us to figure out, but like, we think the renewable energy credit is more, it's like more broadly, you know, one of the worries of the renewable energy credit is it goes mainly to like people can afford putting solar panels. But this is in the upper end, the higher end of the income distribution, but it's not like concentrated exclusively here. So the reason why you have this one big jump, that's mainly for the credit for taxes paid in other states.
but if somebody is paying their taxes for income in Hawaii, why would they be getting a credit for taxes that they pay to another state, which I would assume would be for income that they made in that other state? Or am I just totally being off base?
That's it, right? So if we tax all your income, if you're a resident of Hawaii, we're going to try to tax all of your income, right? However, most in Hawaii is like this too. If you own a business in California and you generate, let's say $50,000 in California, California is going to say, well, you generate it in California, so we're going to tax that income, right? So if Hawaii, but on your, we look at your federal tax information, that's included in your tax information. And so we say, no, we want to tax that. But if you can prove that you're paying taxes to California and you have to do that, then you can get a credit against that, right? And we do the same thing in Hawaii, right? So if a California resident, say, owns 5 vacation rentals here and they're generating all that individual income, according to our laws, we get the income that you derive from.
In theory, it just prevents 2 states from taxing the same income, right?
Yeah, exactly, right? You should only be taxed once. And this is pretty basic tax stuff, right? Like, so if you're like international man of mystery and you're paying taxes in 18 different countries and you live in the United States wants to tax all that income. However, if you prove that you paid taxes to all those 17 other countries, then the United States says we don't have to pay taxes on, you get a credit for the taxes you pay. Now, here's the thing. If their tax liability is lower than what the United States thinks it should be, then you have to pay those additional taxes. Equally in Hawaii, if you only get a credit for the taxes paid, right? Like, it's not like you get to write off all that income.
Thank
you. Is that clear? Yep.
Yep.
Okay. So again, I've shown you this a couple times, but I think this is pretty illustrative, right? So this is your it's a ratio of your gross tax liability to taxable income, right? So this means that if you're at 1 and you make 10% and you pay 10% of all of taxes in Hawaii, that means your income is 10% of all income generated in Hawaii. And we're looking at this. So, right? So below this, like if you make less than between 20 and 30%, you know, the proportion, your contribution to the amount of income generated in Hawaii is, or the taxes paid relative to your the income you generate is about 7.7, right? So you're paying, in this thing, you're paying less in taxes than you're actually paying than your income represents. And up here in, you know, 300, between 300 and 400,000, over 400,000, this means that you're paying a lot more in taxes than your percentage of income in the state of Hawaii. So this kind of goes to show you where the burden is being shifted to, right? So we're shifting the tax burden from these people, which if we had a completely neutral tax system, this should be one all the way across, right? That's the other way to think about it. And it's not, right? We give favors to these people and we're placing more over here. So that's it for individual income tax. I'm flying through this because you guys have seen this before and it's a review. So this is the GET, right? I spent a lot of time on this. One of the kind of like everything gets cited, everything is, GET is an incredibly regressive tax, right? And in some sense it is, if you look at income in terms of 1 year and you look at your income. And so this is what it looks like by income quintile, right? From the lowest 20% up to the highest 20%. The lowest 20% does pay a higher percentage of their income than high income people, right? Now, the first thing you would say is like, oh, we have to do something about this, right? However, I really want to encourage you to look at the numbers down here, because this is income and this is consumption. And what do we see? We see in the lower income 20%, people are consuming about 2.5% times more than their income. And even here on the lowest 20. And so that's how you can, if you ever see, and this is just for the state, but if you ever see tax rates that are higher, if their burdens are higher than the actual tax rates, you should start asking questions, right? Because something more is going on here. And what's happening is, you know, either if this is because of savings or if this is because of, you know, we have a social safety net that allows people to consume more than they earn. You know, this is why they have a higher percentage of GDP. Now, so the question is income the best measure in terms of defining progressivity and identifying if there is an outsized burden on the GET is another question, right? And so I'm bringing all this up because I really want to get you guys to be critical thinkers about all the tax reports that you're reading and to empower you and so you guys can make the decisions about what you are seeing, because there's a lot of things that a lot of numbers that fly out in the press and things, and you know it automatically is designed to get you create a reaction. But if we think about it, and we really understand what goes down, then we can actually develop a more complicated and appropriate policy response, I would say. So again, now there's a couple of things. So GET, that was before that's total income, but after taxes, it makes a big difference, right? Because as we said, once we tax people of the higher income distribution, they have less disposable income too, right? So if we just account for individual income tax, then this goes up a little bit. And this actually comes down because we're offering tax credits. Now, one of the things that a lot of people skip is SNAP, which is our food, which is commonly called food stamps, is not taxed, right? The state of Hawaii is not allowed to tax federal government programs, so we do not tax those. There's about 400, last time I checked, about $400 million a year. Hawaii families receive about $400 million a year just in food stamps. It's significant, right? So that's a large portion of our GET, or a large portion of consumption for lower income people are given in food stamps. Now, if you take this out, because it's not taxed, this goes down even further, right? And it's really important to remember that SNAP is not taxed because, for example, every year we grade a bill to exempt food from the GET, right? At home food. Fine, whatever. But it's usually thought that like, oh, lower income people, food is an essential. Lower income people spend more on their food, so they should do this. When you actually, if you think about it, I'm a middle class person. I spend probably, well, yeah, I spend more on a per capita basis on food consumption than a lot of other people, right? Because I go to Whole Foods, I'm a hippie and spend a lot of money on almond peanut butter and stuff like that, or almond butter. And so by exempting food, do I need the tax credit, right? When you're already exempting a lot of people that are doing it because they're purchasing most of the thing through SNAP. So this is just a good example of something that sounds like, oh, this is very, like, I'm concerned about lower income people because they're like incurring a higher levels of taxation. And so we should exempt the food, at-home food from the GET that costs about $250 million. So it's not a cheap exemption. And yet, who would you be benefiting? You would be benefiting probably middle income to upper income people the most, right? So this is a little bit of a counterintuitive thing that you start to look at more and more you look at this. And again, now at the end of the day, you know, and you guys can agree or disagree, but my whole thing is at the end of the day, everybody spends money. You know, like high income people, eventually they have to spend their money. They're either going to invest it in a business, in which case there is consumption there, or they eventually spend it on things. With the GET, the way it's structured, we're going to capture most of that. The only thing that we really do not capture with GET is the purchase of real estate, right? And people spend a lot of money on homes, but even then, you're supposed to, you know, according to life, or even then, like, you eventually sell your home, right? And then you take that money and you consume it, whether it's at a retirement home or something like that. So when you take it all into consideration, the high income people pay, when you only look at consumption, everybody pays about the same, right? So these are all different interpretations, and you guys, I really encourage you guys to make your decision about what's the most appropriate thing. But what I really am trying to get across here is these are all wildly different interpretations of the distribution of the GET depending on how you look at it, right? And so my goal here is to empower you guys so you can make the decisions that you guys informed decisions. Now, yeah.
Just wondering, your assumption on GET on rents is borne by the capital owner.
True.
I honestly, I have absolutely no idea. Is that true?
Okay, so thanks for bringing that up, man. The reason I think it's true here in Hawaii, you could argue it's borne by the renter as well, right? And so there's two things. Is the renter passing, or let's say you own an apartment, right? And you own the apartment and you have to pay GET. Does the owner pass, if the cost of GET goes up, does he pass all the cost to the renter, right? So in a lot of places, I would argue in some places like Texas is a great example where there's actually, they just keep building houses, right? So there's no, well, let me back up. The reason I don't think it's true here in Hawaii is because we intentionally make housing scarce, right? We just don't build houses. And so the people who own property here, especially people who own property for a while, have a monopoly on property, right? So if you think about this, so if the GET went up by 0.5%, or when you're renting, is it determined more by demand or the cost of supplying the apartment, right? I would say the demand outstrips the supply here. So when you're thinking about when you're thinking about where the price is, think of the supply and demand curve, right? You can either adjust demand or you can either adjust supply. Both are responsive to prices, right? And so in Hawaii, since you know, we have a housing crisis, and by definition, we have housing scarcity. That's basically what it means, right? And that means that more people want to live here and have a home than we are providing for. And as a result, prices are going very high, right? So since people have monopoly rents, I think they're the suppliers of real estate, meaning the renters, are getting a higher price than they would be than just representing the cost of supplying the home. Does that make sense? That was like really long-winded and maybe not the most, so.
Seth, maybe correct me if I'm wrong, but another way of saying that, I've been renting for about 10 years now in Hawaii. And when I look at the cost that I pay in rent versus what I would pay in mortgage if I bought a home, I'd be paying significantly more on a mortgage if I bought the same home that I'm kind of even in right now. And that's partly because of exactly what you're talking about. All of the costs of owning a home are not passed on to the renter. And I think the reason for that is because of the monopoly. The people that own the homes expect a lot of their return to come from capital appreciation. So they don't need to extract every penny out of rent. Rent is part of the return, and capital appreciation is part of the return. And because they know they're going to make money on capital appreciation, they don't have to extract every penny out of the renter.
Yeah,
Yes.
I could add to that. At the end of the day, if you raise the cost to an owner, whether or not he can pass that on to the renter really depends upon the market rent, right? I mean, the
Yep.
going rate of rental is what you're going to pay. If you're going to raise it another $200 and the rent market is less than that, then obviously it's easy to say pass it on, but it's reality, it's the market.
That's exactly right, right? And so normally if something is really expensive, then we would assume that another market player would come in and say, oh, it's so expensive, I'm going to just provide an apartment for slightly less because my cost of providing that is less than that. But we don't let people come in and build new housing in Hawaii, right? Or we do, but it's very difficult, right? And so what's really determining the price is the amount of renters. It's not the cost of supplying that housing. And since it's mainly determined by the demand for housing, the renter, the person who owns the home, is not really passing on the cost of GET, right? Because they're taking all their costs plus their monopoly profit because we've created scarcity within the market, and that's the assumption. And so why that applies in, you know, economists generally think this does apply in Hawaii and San Francisco and New York, and you're not really passing along. However, in like rural Tennessee, where basically a home costs just as much as the land and the cost of materials, then if we had a GET, we would expect that to affect rents, right? Because that really, you can provide as much housing as you want and the government is not restricting it.
So I understand the argument that people pay whatever the market will bear or something to that effect. But does the landlord charge GET, or does the landlord just pay their share of GET and whatever they charge up for their rent is what they charge?
Yeah, so I mean, renters are, or the people who own the houses are obligated to pay GET on all of their rent, right? That is for sure. Whether that's included, they usually don't, my experience in renting here is they usually don't separate it out. And they, you know, here's the counterfactual, you know, 8 years ago, the GET increased in Honolulu by 0.5%, or even in Hawaii, in the county of Hawaii and the county of Kauai. Did rents all of a sudden go up by 0.5% across the board? My guess is zero. My guess is you didn't see anything, right? So to me, that's like a little empirical test to show that they're not passing it on. Now, if you raise GET by like 30%, right, on rent, my guess is rents would go up, right? So it does really matter. Like, again, going back to this original question about how much should you raise tax? people's behavior will change depending on how much you raise the tax. Like a 0.5% increase in GET is not going to make a noticeable difference. If you increase it to 30% all of a sudden, oh yeah, that will affect a lot of different things because it's just the order of magnitude, right? So one of the hard things about economics and when we think about things is there's no hard and fast rules. Things are constantly in flux, playing off against one against the other. And that's one of the hard things about coming up with economic predictions is there's just so many variables going into everything. So now I'm going to move on to putting it all together. Do you guys have any other questions? Okay. So what I did is the US government puts out this consumer expenditure survey, which really looks at all the consumer expenditures for a given household, again, across different income groups. Now I adjusted it for Hawaii because the consumption in Hawaii is slightly different from the average consumption in the United States. And what that really boils down to is we pay more for housing here relative to everything else, right? And then for the GET, for fuel, for all the consumption taxes, we use that as a model. For the individual income tax, we just did their taxes for them on a family of 4 that would do this. We assume that everybody's taking the standard deduction, which is a big assumption, right? Because if you're a higher income, you can usually take some non-standard deductions by deducting your like interest on a mortgage, things like that. And so we just ran everything through to look and see like what would the tax burden pay if everybody nominally had to pay this. This does not include corporate income tax. This is only direct taxes, right? So we all pay a little bit in terms of the public service company tax, which is basically utility tax. We all pay that, right? But we don't pay that directly because that shows up in our utility bills, right? So I'm not talking about indirect taxes. I'm only talking about direct taxes here, right? And these are all the assumptions and how I got the methodology, right? And so with the personal income tax, I'm assuming that if you're lower income, you can take advantage of the refundable EITC credits, right? Or the food credit, the refundable credits. So here's what happens, right? And there's a couple things I want to highlight here, right? So here's the pre-tax income. So this is the average. So the average for all houses, and this is adjusted for inflation and things. So don't assume that this is the average household income in Hawaii, right? But this is because we had to make a couple adjustments, but this is like the income threshold for different quintiles, right? So lower income versus high income. Lower income is like $11,000, $11,394. The highest one is $188,000, right? Now, a couple things to think about, right? Low income houses tend to have fewer people in their household, right? Now, this is not always the case, but this is something really important, right? The larger the household, the more people that live inside of it, right? And that's something that, this shows you that like usually when we're concerned about lower income people, we're concerned about a lower income family, right? Now, this does not we do our best because there's definitely larger households in here, but most of the households are not like that, right? Most lower income households they're usually retirees. If you looked at the average age, I don't think I have the average age here, but it's like usually the average age is the highest here and it goes down with time. So these are younger family households. But what I really wanted to show you is like the amount of people, like we calculated their GET, we've calculated the other excise taxes. So this is like tobacco, alcohol, things like that, fuel. We figured out the motor vehicle tax and the individual income tax for these different quintiles, right? And we looked at the total tax. So according to this analysis, the average household pays about $5,625 in taxes, direct taxes, right? If we look at the lowest income, they pay $418 in taxes. and it goes on up. And the highest quintile pays about $13,000 in taxes. This includes $2,500 in GET, and when we get to the higher income, $9,900 in terms of individual income, right? We can look down here. You look at all this, it seems high. If you look at after federal income tax, right? Because federal income tax is a progressive tax structure as well. So this is your disposable income. It even gets, these numbers even get bigger. So this is, you know, this is the before, this is their income before federal income taxes, and this is after income taxes, right? So this is a progressive tax structure, right? So the people at the lower income pay about half as much taxes as the people at the upper end of the spectrum. Does anybody have any questions about that?
I got a quick one, Seth. I know the focus obviously here is on state taxes for obvious reasons, but on that previous chart, do you have anywhere, just to satisfy my curiosity, and if it's something we can do offline, that's fine, but do you have anywhere on that bottom row, instead of having tax over income after federal income taxes, have state plus federal taxes over total gross income? I'm curious what the total tax burden works out to be, state and federal, over total income, which would be obviously a much higher number.
Yeah, I don't have that analysis. If you guys want, that's something we can work on. And I will just point out that with the recent legislation that's been passed, it is an incredibly progressive piece of legislation that would really shift these numbers, right? I mean, low-income families are receiving upwards of $10,000 for, not because of the stimulus bill, because of the child tax credit and other things down here. So if we wanted to do that, that's something we could do. It would, I think we would need to we couldn't use these numbers. We would have to update these numbers new, because the package that just passed is very big and really changes. And you know, I think you're making a very good point. Is one thing I do see here in Hawaii is they only focus on state taxes, right? But most people, state taxes is the afterthought. It's the federal taxes that really motivate behavior, right? And so when we really think about behaviors and burdens and everything, we should really think about federal and state together. And if that's something you would like to see more of, we're definitely open to providing that analysis for you.
Seth, you talk about the most recent package. You're talking about a federal package, or you're talking state legislation?
I'm talking about the federal stimulus package that just passed recently, the American Recovery Act.
Thank you.
Yeah.
Seth, do you have any information that would allow you to distribute the burden of property taxes by quintile?
Yeah, so well, this is, again, I can do it, and I try to do this all by like being totally honest about the assumptions, right? So if you really assumed that GET is not borne by renters, then it would increase with here. I don't know, it's a lot harder to do for us to do it, because everybody owns different priced houses, and that's more of an individual, right? And so we use the consumer expenditure survey does not ask, I don't think, how much property or how much your house costs, which is what we would need to figure out your property tax.
Okay, it's not that big a deal, just wondering.
Yeah, but in generally, if you assume that, you know, lower income people tend to not to own their places. So if you assume that it's not borne by the renters, then it's much lower and it increases. It's progressive, right? If you don't make that assumption, then it's neutral to maybe even regressive, because lower income people pay a larger percentage of their housing, or of their income on housing too.
Seth, I understand you just answered Scott's question, saying that your comment was in reference to the federal package, but isn't there also a bill going through the legislature right now that would make the state income tax significantly more progressive?
Yeah, and we can talk. Oh, that's a great point. So just in terms of like There is. It's SP 56, and that would raise income rates go from 12 to 16%, right? And so I think this is a great illustration of the uncertainty around things. So we provided that. I forget the exact number because it provides increases state taxes, it eliminates some exemptions on GET it'll suspend some GET exemptions, it increases the conveyance tax by like 2 or 3x, right? So we provided that, and I forget the final number, but it's in the range of like, I think 280 million, right? Now, we provided that. The real revenue impact could be negative, right? So you get 8 of our top, or you get like 100 of our top individual income payers and who've decided to leave, and that's basically all of the revenue. All the revenue, even any increase in revenue is offset by these major players that leave, right? So it's, and we don't have the ability to like predict that behavior. So we just give it to you and say, this is the maximum amount that you could have, but we are trying to be as honest about what we don't know when we provide these numbers. Numbers are helpful, but they should, I think numbers are best given with like bands of uncertainty around them, right? So that's just a great example of, it sounds great to like raise taxes and we can just do the numbers. And if we said, if nobody changes their behavior, this is how much money it would be raised, but people do. And the bigger the tax increase, the bigger the change in behavior. So going from 12 to 16%, that's a 50, though it's nearly a 50, it's like a 35, 40% tax increase, right? That's gonna change some people's behavior, right? So we just didn't know a lot about that. And it's just, I try to be as forthright about that as like what we do not know, while trying to give as much information so people can make an informed decision based on like, and what I try to do is I'm always like, these are our assumptions, these are assumptions, these are assumptions. So you can decide if these assumptions may or may not be valid.
But when you talk to the legislature, you do raise the point that people can vote with their feet and just leave, and it could be, you did raise that point, yeah?
Yeah, well, we always say this is a maximum amount. We do not know, this does not include a major behavioral shift, and, it could be less than this, right? I mean, we just never know. And it's very hard, and even in post hoc, like even if we did implement this thing and we could see the results, you still don't know really if they left, and some people did leave. You don't know if some people left because of the tax increase or because we don't have a lot of, they were leaving for better, greener pastures. We just don't know. It's so hard to model these things. I mean, when we're talking about a macro economy, we're talking about 1.2 million people making individual decisions on every single year, and we're trying to predict that. And that's just for the state of Hawaii. So this is, I did this is kind of an interesting little portion too. So I broke down like the tax burden by income decile. And so this is for the average. So the average family unit pays most of their direct taxes in the form of individual income tax, right? This is the individual income tax. This is the motor vehicle tax. This is the other excise taxes, alcohol, cigarettes, things like that. And then this is GET. So this is what the average family pays. Now, in the lowest income people, you get a tax refund, so that's why it's negative. And this basically cancels out the GET, which is basically means the food and excise tax and the EITC are accomplishing their goals, which is to eliminate the burden of the GET on lower individual income tax. Then you get to see the biggest tax payment that a lower income family has is often the motor vehicle tax, which is interesting, right? So it kind of shows you where different things. Now, excise taxes, especially like what we can traditionally consider sin taxes, are usually borne more by lower income households, and that's because we tax sin taxes. They're not ad valorem taxes, which means we don't tax according to their price, we tax according to their volume, right? So alcohol is not like the tax on a $3 bottle of wine and a tax on a $200 bottle of wine, the alcohol portion of it is the same. Alcohol tax portion. The GET tax portion is different, right? But like that's just how a lot of like sin taxes are. Same thing with tobacco, right? Doesn't matter how nice your tobacco is, it's the same. We tax the same amount, but by cigarette and by different things. So by design, almost sin taxes are supposed to be regressive. So it's just kind of really informative to show you like where the larger tax burdens are for lower income people relative to everything else. So that's it for, so then I'm going to go through the ITP thing and we're going to look at like why there's a big difference, because there's a huge difference, right? So I just came up with 3.6 to 8.5, and the student for taxation economic policy came up from 15 to 8.9. We're going to look at the difference, right? But that's a big difference, right? Does anybody have any questions about the analysis that I provided? Okay, so again, the Institute for Taxation and Economic Policy is a very acclaimed and prestigious think tank and advocacy who I read a lot. And so I'm not saying what they're doing is like disingenuous, but the thing is, it's important to understand why there's a divergence in studies, right? So if you ever do that, the way to look at it is you got to go to the footnotes, right? So I looked through all the footnotes of this study and I can identify a couple things that went. One is, well, let's just start where, make it easy. So GET, so it's 4.7 to 0.5. 4.7 was very close to what I had originally, which was 4.8 for the lower income. And how do you get to 0.5? Well, I went back and I looked at their definition of income, and their definition of income includes all the things that are like above the line, what we call above the line. So this is, you know, your healthcare, your contribution to your 401k, all those things, they added that back in. Now, whether you should include that or not is up to debate, right? Because those things are not taxed now, but they're taxed later. When you take out your 401k, they're taxed, right? So that is one source of why these numbers are low, because you make people's income much bigger by saying like all the stuff for retirement and stuff is being saved, and that's also a portion of your income. So that's one of the reasons you get so low down here, whereas we did not get that low. The other thing is the sales on excise. So they look at like this is the whole tax pyramiding issue that we did and we talked about with the GET. So they think tax pyramiding issue is like the tax almost doubles, right? When we look at our closer relationship, we found that the tax increases by, it goes from 4% to 4.7%. So that's a 20% increase. So rather than having the 3.8 here, we would have 0.7. So this is another source of the difference. Individual income tax, ours are a little higher on the upper end. The other thing is, and what you see is, you know, they're using income, but obviously the people down here, if you're going, these people are consuming more than their income, right? So one way to look at it is you want these to be as higher. If you want to increase our social and safety net, you actually want these numbers to be higher, right? You want this to be 20%, 15%, 20%, right? Because you want people to be consuming more than their income, because we want to transfer things. So that's one way to think about things. So that, I just wanted to take you like and also the other thing that they leave out is in their income, they do not include in-kind transfers in their income, right? They also don't include refundable tax credits. So the EITC and going forward, child tax credits are really important, right? And in the state of Hawaii, food and our food and excise tax credit, our renter's credit, those are really important. In addition to food stamps, in addition to rental subsidies, all these are really important. And so that's why you get such high numbers. Now, so when you read this, and the first time I read it, I was like, oh my God, we need to do something about our taxation system. This is totally wrong. We do not want lower income people to paying more in taxes than upper income people, right? But the more I've spent time with this, the more these numbers start to make, I understand where these numbers come from, but they're not as, we don't need to reorient our whole taxation system because of these numbers, right? So what it means is that these people are consuming more than their income. And I understand, I don't necessarily agree with their definition of income, but that's fine. Like, we can disagree about whether you should include your before tax savings in there or not. And you know, the level, I mean, I feel pretty sure that the level of tax pyramiding is not as high here. And that's what's driving up this 10%, 10.5% number. But I would really encourage you guys, anytime you see like a GET sales and excise tax is 10.5%, and that's way higher than the nominal rate, I would really encourage you guys to take some time and think about how you can get higher than a nominal rate, right? Because that's hard to, with GET, it's only what you spend, kind of, right? And there's different ways to have implied taxes, but you have to do that. So since you guys are all commissioners and tax experts now, I hope you guys can read different tax reports and look at things that like raise an eyebrow and dig deeper into the weeds so you guys can make the decisions yourselves. Do you guys have any questions about that?
I just want to say thank you for helping to demystify that difference, because I was certainly puzzling over why there should be such a major difference.
Yeah, and I think it's like, we should have these discussions, right? And so a lot, like what it does show you is like how you estimate something and how you define something will have major implications to the conclusions of your analysis. Now, you know, when I first look at this, I was like, oh, we need to adjust our tax policy. But really, if you are trying to provide social income, maybe you want to increase these numbers. Like, that helps us understand I think this clarifies the best approach to economic policy making given somebody's goals, right? That's kind of how I think about things. Any other questions, comments? Okay, so I'm done with that. So, and now I'm just gonna do a couple quick slides about the power of growth versus taxation, right? So this is I just wanted to show you something that it's so banal, but it's so important too, I think, is like, these are different growth rate. Like, this is the general fund revenue projections starting now. So this year we have a negative, according to the core, we have a negative 11% growth rate. That's right here. And then I just make 3 different projections. I was like, one, if we grow 3% continuously for the next 25 years, 4% or 5%. And what I really, down here, you see this is the cumulative. So this is the total amount of money that would be raised over, you know, 10, 20, and 25 years. So just to make it, at 3%, over 25 years, we would raise $223.8 billion, right? If we grew up 5%, that's $298.6 billion. So that's a difference. Down here, I like have all the differences, and this is the difference of 3% versus 5%. That's $74 billion. So just growing at 2% this is more than the pension crisis. This is a lot of money, right? Now, this does not say like this is all extra money, because the costs of the state are going to go up even if you provide the same services. But what I really want to highlight here is the importance of growth. The difference between 3% growth and 5% growth are enormous over the long term. Now, I look at 2046, I'm like, oh, that's too far in the future. But if we go backwards, 25 years ago, 1997, which I have clear memories of 1997, right? So this is definitely within the realm of what we should be thinking about and what we should do going forward. And you just, this is the exponential, this is what happens when you have compound growth, right? And so it's really important. Now, if the average general fund growth rate from 2001 to 2019, I took last year out because it was such an outlier, is 4.8%, right? This is nominal growth, right? So when we talk about GDP growth, we usually talk about in terms of real growth, which takes out inflation, but this includes inflation, right? But growing at 5% is much more important than growing at, or like has a huge impact compared to 3% when we're talking over the long term. And you guys are tasked with thinking long term, right? So if you really are considering revenue implications, creating pro-growth is very important. So over here are just two more interesting things. This is just like 1%. This is like the average revenue that it would be in 2046. So if we only grew at 3%, in 2046, general fund revenues would be about $12 billion, right? If we grew at 5%, they'd be $20 billion. So that it's enormous to change, right? And so this is also what 1% of this total would be. So all of a sudden you're like, if you could just increase growth a little bit, it's $201 million versus $124 million. It's enormous, right? So the reason I do this is the Council of Revenue currently has their long-term growth. They only do it out to 2027, but now yours it's 3.5%. 3.5% would be catastrophic for the state budget, because we would not have a means of paying for all our unfunded liabilities. At 5%, it's doable, right? So I'm just showing you, this is totally hypothetical and just for example's sake. But what I did was I said, okay, what if we just did a $150 million tax law change? $150 million is a big tax law change. I have yet to see a $150 million tax law change. I've been here for 4 years, so not that long, but it doesn't very happen. Now, I just wanted to show you what is the impact of a 150 million. So I have 3 different scenarios. So I said, okay, let's base, this one is the 5%, the solid, all the solids are just no tax increases, right? So this one's 5%, this is 4, and this is 3. And this is just their first 10 years. Now I said, okay, let's just start with 4%. I said, what if there's a $150 million tax increase? Great, we're gonna plug the puka. So if we did this, you can see here, it grows, it helps, but by basically in 2 years, if we just had 1% more growth, cancels everything out, right? And then, you know, it's lower and lower than 5% growth for the rest of the time. So just in 2 years, you wipe all that out. Same thing. Now, let's say what happens if you did pass this, just for example's sake, and I'm not saying it happens, but let's say you pass the legislation, $150 million, but it lowers growth by 1%, right? So then you follow this orange dotted line. So at first, you're good. You make a little bit of money for 1 year, but by the second year, you've lost. You're at a net loss for the state. And then it goes down further and further and further and further. Or here's another example, and this is something that you don't see often in Hawaii. What if you reduce growth or reduce tax revenues and increase growth, right? So this is the gray dotted line. So, okay, you do it. So it's worse than all of the other scenarios for the first year. By the second year, you're getting close to 4% growth, but like by third year, it's basically paid for itself. And if you had growth going all the way up here, it'd be increasing much more than the 4 or the 3% scenario. So I just want you guys to think about this because, this is, you got, I'll include this, but these are all like the numbers that are included, right? So if this is over 10, 20, 25 years. And so what you see is like, if you, this is all compared to the 4% growth scenario, but if you increase it by 50, you did a tax increase of 150 million, but decreased it growth by 1%, you would have a $2 billion loss over the first 10 years, $2.3 billion loss. This number seems, this number seems wrong. I'll correct it. And then a $25 billion loss over 25 years, right?
So Stephanie, we're just talking about how hard it is to predict what a tax measure will do. So how would we think about how taxes that we might consider would change the growth rate?
Yeah, I think we'd have to go, I'm happy to think about those things, but like, one, it depends on the type of tax, the amount of the tax increase, like what we know and what we don't know. And saying what you don't know is just as important as saying what you do know in a lot of these decisions. So for example, the SB 56 is a great example, right? If it doesn't impact economic behavior at all, then it for sure would be a tax increase, or it would sure increase general fund revenues, right? But let's say it's like it increases a bump, but after the next 3 or 4 years, growth really suffers, right? Because a lot of people, we are the highest tax state in the country, we do all these things, it's not possible. Then our growth level goes down 1%. I mean, at least you can work through in your mind what could happen or what could not, right? And so you're saying, I do that because I make my assumptions a little bit more explicit. So I will never be able to give you guys concrete numbers about what's going to happen or say what's going to say, but we can say, oh, these are different scenarios and these are the different factors we want to take into account. So unfortunately, I can't give you a good answer, Beth, but I'd much rather, my goal here is to help you guys think through these things versus give you answers, because I cannot, right? But I do want to think like, like in the first, that self-help book, Getting to Yes, the first thing they always tell everybody is like, okay, agree upon principles, right? And if you want to agree upon principles, so like, I think a lot of people in this country, or this state, are really interested in investing in people and making sure that they have as much, we have state resources to invest in these people so that we can create human capacity so they can live the lives they want, right? Like, that's not a very controversial statement. In politics, we get controversial by saying, oh, does that mean we should raise taxes now and create a program, or should we wait and have create a more business friendly environment, which would enable us to have money further down the line? These are the questions that we have to think about. And by thinking in terms of these scenarios, I think it just, to me, it's really helpful. And I'll just end on this kind of like apocryphal quote by, usually it's Einstein. It's like, he was supposedly asked, what is the most powerful source in the universe? And it's compound interest, right? And so basically, his whole point is not necessarily compound interest, but like, if you can think about all his theories as you approach the speed of light and things, is like thinking exponentially. And we're all part of this with COVID, right? Like, most people didn't understand the risk of COVID because they're like, oh, 1,000 cases a day, no worries. But think about epidemiology, is things that increase exponentially, and they go up really quickly and change the whole scenario, just like growth. So like, the difference between 3 and 5% is, you're really laying on the exponent here over the long term, because they compound. And so the more people think about that, I think they could have, especially when you're thinking about a 20 or 15, 10, 15, 20 year time horizon, you should be thinking exponentially. You should not just be thinking arithmetically in this particular year. So with that, I am done with my presentation, and I these are the end of the presentations that I had suggested. I'm happy to provide other information, other feedback, other studies, other informational briefings, but I really cede the kind of like the intellectual leadership over to you guys now.
Sorry, I had one question to clarify. Well, I'm on mute. I'm on mute probably. Oh, I'm not. On the growth rate you were talking about, that the percent of growth is growth in the state product, like state domestic product.
No, this is the general fund. So this is the
Which, right.
general fund is like basically the discretionary budget that the state has.
Right, which is driven, 40% of it is driven off GET, right?
Yeah, but that's different from GDP, gross
Okay.
domestic product.
But basically, I mean, in order to get to that growth rate, we're saying the general fund increases as a function of the amount of taxes we're taking in, right?
Correct. This is it's exclusively due to the taxes we're
Right.
taking.
So I mean, the larger economy in simplistic terms is growing by that amount too, roughly, because that's the tax amounts that you're increasing, you're taking in as revenue.
We actually increase our general fund, our take of the state's take of the overall economy actually increases more than GDP growth, nominal GDP growth. And the reason for that is our individual tax system. It is not indexed to inflation. The brackets are not indexed to inflation.
So it's reducing over time.
Yeah, that means everybody's getting kicked into higher and higher tax brackets over time. And so we charge more. And so that's kind of like one of our hidden fees that people seem to like.
And the credits aren't indexed either, right? So then the relative value of the credits are reducing over time.
Yeah. So if you look at most of it, unless they are indexed to inflation, most of our tax income our income dependent tax credits reduce over time because more and more people become less eligible for them.
Right. Okay. Thanks for clarifying.
Okay, thank you, Seth. Before we go on to the next item, does anybody have anything in particular that you'd like Seth and the staff to prepare for the next meeting? Are there any gaps in our information that we should prepare for April? Okay, hearing none. Then I want to go on to the next part, which is identifying potential issues and themes for our work this year. And I know it's going on 1:30. Scott at least has to leave early, so we aren't going to have a whole lot of time to talk about this, but maybe we can at least identify some issues so that it will set the scene for our agenda for next time. Would anybody like to volunteer to identify what tax issues you feel are most important for us for our consideration?
I'll go first. I may or may not have to leave. I'm on call. It starts at 1:30, but you know the council moves like snails too, so maybe 2 o'clock. So never know. But you know the items that I've looked over, and I've looked back to the 2000-2003 commission. I thought that was very interesting read, as they talked about just the framework. What is sound tax policy? I thought it was a good article about, you know, there are 5 principles that they talked about. And, you know, we talked about whether or not, I saw the grassroots testimony about if you raise it from 11 to 14, 15%, whatever, potentially doctors may no longer live here, et cetera. They may move away. It goes back to this policies is you shouldn't be using the tax policy to identify what would happen to a certain group, et cetera. So it's kind of good read, I thought, to read if you haven't had a chance to see just general principles of sound tax policy by Brunori. Sorry, I don't have my glasses on. But I thought it was a very interesting read. And using my somewhat expertise in county property tax, and looking at it to the state, one of the things that I thought just for myself, not for everybody else, but every time you look at raising tax rates on a county, which category, et cetera, you always got to be mindful of current subsidies. Before you start raising taxes on everybody or a category, et cetera, we always try to remember that somebody's getting a subsidy out there. And over time, you need to review it, in my opinion, because whether or not it was good 20 years ago, is it still good policy now? So you have several accountants out there, and I'm not one. So when I think about exemptions, similar to county exemption, home exemptions, et cetera, should we be looking at people who are getting exemptions under the current system and see if there's still a nexus behind if it's still necessary? Because times change. That's one question I had. You know, whether it's a movie credit or if it's a credit for a hotel project, et cetera. I'm just wondering, sometimes you give credits to special interest groups, and I'm just wondering, is it still warranted? That's just one of my things. And the second part is, every time you have policy, you're only somewhat as good as your enforcement. For example, we have long-term renters credit, we have, you know, B&Bs, et cetera, et cetera. If no one's out there to enforce it, it really there's very little meaning. So I guess another question to the state is, how good is their enforcement of what's going on out there? So I just throw that out there. I'm not saying there's any issues. I just say, before we start looking at making major changes, are there things out there that should be re-looked at from the commission standpoint? And I don't know. That's just my comments. Thank you.
Yeah, I
Yes,
think to follow on to Scott's last comment, I mean, I think in the 2005 to 2007 report, there was a comment made about investing in the state tax, deal tax infrastructure, basically. And I fully support that as both a member of the commission and as a kind of practitioner in the community. I mean, to the extent that, you know, a lot of state infrastructure IT functions in the COVID crisis shortcomings have come to light. And prior to COVID, there are certainly a lot of things that can be done, and I think making it a clear point that investment in the deal tax infrastructure is warranted because of things like enforcement, right? I mean, before we go out and to Scott's point, to seek other sources of revenue, we should make sure that whatever we have on the books is being enforced.
Any other comments on Scott's? Who wants to go next?
Another quick comment, if I may,
Oh,
Chair.
yeah.
And only because we do the renters credit that, you know, rent relief to people, and, you know, hate to say it, but, you know, in our experience, and I might have mentioned it earlier, we find about 30% of the people who could qualify for this renters credit are not able to do it because the owners are not paying taxes. Therefore, my question about enforcement. So are they not receiving the GE or the tax on the renters because people just don't do it? And sometimes if you raise it too high, it maybe goes opposite. And for example, if the county raises trash bill from $20 to $40 a month, you think you're going to collect more money. Well, in hindsight, people won't afford it and the trash would just go on the road. So you're just actually spending more money to pick it up. So it's kind of that balance between which way do you go? You think you're doing a good thing, but you're really not going to get it. So I just caution us on some of these things, is which way we go, is just because I see it at the local level. So like I said, you know, yeah, we can raise the GE, and how much more money you can get from renters, I don't know. Maybe more people will go on the other side and not pay their GE. So sometimes less may mean more. And kind of Seth kind of went to that, is sometimes by lowering things, you might get more out of it in the long run. Just my thoughts.
Just asking for my benefit, I think I understand the enforcement and the, you know, potential to invest in IT infrastructure or whatever for DOTAX. Was your first comment, are you requesting kind of a broad level review of all the subsidies that are out there, or the major subsidies, and kind of taking a look at them? Is that what you're asking for?
Yeah, like for us, what we do is we have a lot of different subsidies. I'm just saying we should know maybe what are the subsidies out there and maybe focus on the higher ones, because when the subsidy is so low, it's, I mean, yeah, you might correct some, but there's really no impact. I mean, some out there may be so large subsidies that you might want to say, hey, God, why do we do this? You know, I just, you know, for government, we've been around so long, and some exemptions are out there and people have no idea why we even had them, or when is it still valid? And we had, in the county, we had pulp manufacturing exemptions. Like, what? You know?
So I mean, not to, so for full disclosure, right? I mean, there is, for GET and use tax exemptions, there is a legislative process that they do come up under legislative review every 2 years. I think all of the exemptions are subject to review, and there was a legislative report that was issued in June of 2020 that related to some of the exemptions. So again, as a practitioner in the community, a couple of those taxes related specifically to Hawaiian Airlines. They dealt with the acquisition of aircraft, the leasing of aircraft engines, the maintenance facilities, and service on maintenance of aircraft. So they did come up as part of SB 56 as part of the exemption for GET and use tax. So I will be completely honest that we, in efforts to educate the legislatures on what the impact would be on the state, we did run an educational effort of what the cost of those exemptions would possibly be in both economic and employment terms. So I think that process is part of the legislative process to educate legislators, but there is a review process for exemptions on use tax and GET.
Thank you, appreciate that.
Thank you. Sale, since you have started talking about some things that you're concerned about,
Sure.
would you like to continue?
Sure. Yeah, I think the 2010, 2013 report, and with the, I think we talked about it before, the kind of Simpson-Bowles model on, I like to Seth's point, I mean, we don't have purview over spending, but to not take spending into consideration it's difficult, right? And I think through Seth's effort also, I'm convinced that and through reading the past reports, I'm fairly convinced that our current structure is equitable to the various income groups, and particularly in the last slide where we saw GET being offset by the income tax credits, right? I think it kind of proves out to me anyway that the impact is being mitigated, the GET impact is being mitigated on the income tax side. So if there is a need to increase revenues for reasons that are identified in the process, spending is addressed in part of that mechanism. But if there is a need to increase revenue, I think the GET, the mechanism by which the GET works now with an offset to an indexed or an income tax credit would be the fairest thing to do. So I those two things I think go hand in hand. Like if it does come out that there is a need for additional revenue to address like the long-term pension funding or the unfunded medical liabilities, then it's the most, to me, the GET process is the fairest and we can export the most out of it. And if there is a concern about impact to low-income people, it would be offset with income tax credits. So that's so kind of overall theme that I got from the other reports, and including that investment in deal tax enforcement and infrastructure.
Okay, thank you. Any comments on sales contributions?
I probably have the counter view. Although I found Seth's information really important. The whole idea of tax equity is sort of my big interest. And I think there's been a lot of information on tax equity for those at or below the poverty level, the federal poverty level. Hawaii's population of ALICE folks is incredibly, it's growing. Our 40% of our population is ALICE level or below, and they don't have the same kind of safety networks that Seth was talking about. I don't profess to understand the regressivity with respect to that population. But I do think that increasing reliance on general excise tax has the potential to really further burden this group of our constituency. They can't make ends meet. Taxes is their second highest expense, second only to housing in Hawaii. So I'd sort of like to look at maybe take a deeper dive at whether the general excise tax in particular, whether some things can be done to address the regressivity of that. Now, I know that's a problem when we're all looking for tax adequacy too, but I just think we're going to drive our population further into homelessness if we don't sort of stop this continuing burden on this group of people.
Thank you. Kate, do you have some other things on your list you'd like us to prioritize?
Well, the other thing, and I don't even know if it's kind of a flyer, but property tax, like, can we ever, is that just a done deal? Can we not touch that? Is that, because that is one way to tax wealth as opposed to income and consumption. And this sort of grand bargain that we made 30 years ago, I don't know, is there a potential to revisit that? I've seen some things in the ledge recently. I don't really know if that's within our purview, but I'd be interested in exploring that.
Does that require a change in the state constitution? Do I understand that right?
Yes, it does. So maybe that's not within our purview, but
Kate, if I can add to that, I was kind of thinking along the same lines. And because we can't do it by constitution, and Scott is not going to like this, but maybe we reduce the TAT allocated to the counties, forcing them to make up that difference with real property tax, because they have the authority to increase their rates. And whatever we cut back on TAT goes back to, say, the general fund. So it's just a matter of how we're assessing that tax. And in fact, the House Bill 1314 is actually trying to do that for a different purpose, but the mechanics of it is basically the same thing. Do you have any thoughts on that, Scott? Am I pushing
I bet Scott has thoughts on that.
Man, I know where if it was, oh God, that's a hard one. I mean, for sure, it's a constitutional issue that needs to be voted by the majority of the taxpayers. I understand your point. I think you can argue it both ways. I mean, we always say property taxes are too low in the state of Hawaii.
Yeah.
I mean, you know where we stick it in Maui County. We're the only county that has a timeshare tax. They always say, well, I know what the House Bill 1314 was to, hey, you want more TAT? Well, you know what, we get zero anyway. We budgeted zero for 2 years, and even going forward, we're budgeting zero because we get nothing. Every year it continues to go down, so we don't even rely on it anymore. Because for budget purposes, when we go out to bond, and if you're saying you're going to get $13 million and you get governor gives you zero, there's an issue. So we always all 4 counties are actually basing it on zero. So, I mean, I understand it, and I'm not here to totally object to it, but I think for sure it's going to be the voters to make that decision. And it'd be very difficult for the state to just have a consistent rate because all of the 4 counties are so different in their tax structure, how they're classified properties. The rates for us in Maui County is very low versus other counties because Hilo, you're going to see their tax rate is high, but their values are so low. So it's very hard to just implement a tax rate across the board. And it was very difficult last year when they said, hey, put a tax rate for education. Yeah, you know, a lot of local council members are going to say, well, then stop using all of our parks. Every school is adjacent to a park. You guys use all of our parks, but you don't maintain it. You don't cut it. You don't do anything to it. The counties maintain it. So, I mean, and your legislators are going to say it the other way. Well, we subsidize more. The governor is right now trying to pass EMS to the counties. More and more state functions are being passed on to the counties as like an unfunded mandate. So I don't know. I mean, I think at some point you just need to put it out to vote and then cross that bridge when it comes. I understand they're going to say the rates are low. And we're trying to raise them, but we raise them at places like Seth knows where you're not a voter.
And if I could just jump onto that, like with House Bill 1314, all of that seems to me totally contingent on moving the responsibilities of providing public services to the counties, right? Like the state needs more money. And if you're going to require the counties to raise all of their revenues, then raise more revenues, then you should make them responsible for providing more services, right? So, and that just gets to this really weird situation that you guys are in, which you're only supposed to about tax, but this is really about, if property tax is really about who should be in charge of the schools, like the lifeguards, like that's a bigger question. And once you address that question, then you can address the revenue question, right? But like, to me, it's always the 1314 is basically trying to force the issue by basically taking away, we're not going to give you any taxes or any revenues, and we're going to give you less services. So you're basically indirectly, without it saying anything in the bill, that they're trying to change the relationship between the counties and the state.
It was at 1978 CONCON, and
Yeah.
your forefathers, whether it was Governor Burns or whoever, more no child left behind, be like the mainland school districts. The revenue you get in your school districts are going to fund whatever, and that's what, you know, reason why people move in certain jurisdictions or not. But I get it, and you know, for us, Mayor Victorino is one for sure. It's like there's no way we're not going to be helping our school kids. So even during the pandemic, I mean, we're not required to fund state, but we gave them all of the laptops they needed because we're not going to leave our kids behind.
Mm-hmm.
So that's a tough one.
Thank you. Kate, do you have anything else on your list?
No, other than I like Seth's plan of lowering taxes for everybody and increasing growth and just making it all better. So if we could figure out how to do that, that's a good plan.
Well, I do think that it is really important to note that whatever we are contemplating, we need to be thinking about consequences. You know, is it going to increase growth? Is it going to impede growth? Or how can we predict? So I've got Alton and Murray. Which one of you wants to go next?
I'll go.
Okay.
So I think Sale brought up the expenses and the Simpson Bowles Commission, and you know, I agree. I mean, I'm an accountant, and we look at our clients, and you know, in the state situation, we have falling revenue, increasing expenses, more debt. It's just not a good situation, and I think the state has to manage their costs much better. And I know there's a lot of things that go into that, and that's I guess beyond the purview of our committee, but it's been mentioned in the reports for 2012 and 2017. And I think we should at least put that forth in our report. And if we can figure out how we can legally do it, that'll be even better. But I think there's smarter people around than I am to figure that out. The other thing is, you know, Seth talked about growth and I guess economic growth in the state. And I'd like for us to consider targeted tax credits. I think in the 2012 report, they did a good job of outlining some, I guess, criteria for targeted tax credits that would make it more accountable. I have to say that some of the credits that we've had in the past have been boondoggles for certain industries, and obviously we have to prevent that from repeating itself. But you know, I think there's a way of perhaps incentivizing investment in Hawaii through whether it's credits or deductions or something tied into the state tax. And I also agree with the enforcement issue. I think that's a big hole that we can fill. I know that the State Department of Taxation a couple of years ago upgraded their computer system, and I know they had a lot of problems, but it seems to be working much better now. But in addition to the people that are not paying their tax, I think there's a lot of potential for revenue through just the internet sales. You know, we just had a case called the Wayfair case pass, and it kind of sets forth the criteria for states as far as internet taxation. So that's kind of coming into play now. And I think if our Department of Taxation can really enforce that and do a good job at it, that'll create a lot more tax revenue for us. That's all I got.
Yeah, just
Thanks,
to tag
Alden.
on to Alton's last comment, right? I mean, it's not only additional tax revenue, it's leveling the playing field, right? I think that's what a lot of businesses in Hawaii are asking for, is a level playing field, where you're not giving some out-of-state people advantages that you're penalized basically for doing business in Hawaii in a lot of respects. So I think that's what a lot of us that do operate businesses in the state are just asking for, just a level playing field.
Thank you. Okay, Murray, you're up.
Well, I've got one new one and two that came from previous commission reports. The new one, as I mentioned before, I kind of complained about the fact that we don't have access to consultants and new studies and money and stuff for that. But the one new study, as I think I mentioned in the past, that we do have is the carbon tax study. So even whether we decide to take it up or not, I do highly recommend that everyone read it. It seems long, but a big chunk of that is appendix, which unless you're a quant nerd, you can just leave the appendix aside. And it reads a lot faster than it looks because a lot of it's charts and tables and graphs and stuff. And so you can get through that in 1 to 2 hours tops, you can be through it. And it's actually pretty well done. There's some pretty good information there, and they break it down by how it affects people by income quintile, some of the same type of analyses that Seth did, you know, looking how it affects different parts of the populace. So I think carbon tax is really high on my list to at least look at. And I don't want to go into defending that idea too much right now since we don't have time, but I would point out to the folks maybe that haven't read it yet that one of the options is to return that carbon tax in equal shares to all the taxpayers, in which it becomes very progressive because it still disadvantages fossil fuel consumption, but everyone is actually financially better off after that income is redistributed back to taxpayers, and it ends up becoming progressive. So if you're worried about it hurting people financially, actually, if you do it in that fashion, people are actually financially better off, and yet you've still disadvantaged fossil fuels, which is a good thing. Anyway, so that's one thing I would propose. Two things that are a little bit maybe more boring that came from past tax commission reports that I think need to be looked at, even though they are a bit boring. One is the updating of the standard deduction and personal exemption. We should update to federal and then index to inflation and leave it alone. I mean, it's just stupid that it wasn't indexed to inflation from the beginning. So just like past tax commission report said, update it to federal, index it to inflation, and be done with it. And then that, I understand, will reduce tax revenues to some extent because you're given higher numbers on those deductions and exemptions. The thing that could potentially balance that, and that might be the source of some number crunching we might need to do, is the other thing I've complained about is the real big, in my mind, disequity in how retirement income is treated. Defined benefit and defined contribution are not, I mean, defined benefit, I don't believe is taxed at all, and defined contribution is taxed. I just don't understand how you can have two retirees making the same exact amount of money, one defined benefit, one defined contribution, one gets taxed, the other one doesn't. It just seems completely unfair to me. And so I think that they need to be taxed the same. And if you want to tax them the same but lower it or whatever, I don't care so much, as it just seems completely unfair to have them taxed differently. So I would personally be interested in seeing, if we pursued that, the net effect of increasing that personal deduction and standard exemption, which lowers revenues, to treating retirement income, whether it's defined benefit or defined contribution, the same, which would increase revenues. I'd be interested in seeing the net of that. and see what that looks like. It just seems like those are two big things that should have been adjusted, and multiple tax commissions have commented on it. So I'd like to see that too. So those are my three: carbon tax, personal exemption, standard deduction, updating, and treating retirement income more fairly.
Thank you. Well, that leaves me, and I think the items on my list, just as a general principle, I want to make sure that our tax system stays as progressive as possible and is also adequate. And when I'm talking about adequacy, unlike perhaps some other folks, I know that there are the people who think that the best strategy is to reduce taxes and regulation, and then there are others who think that we need to use our policy tools to try to give everybody opportunities and level the playing field for lower income families. And I come down on the side of trying to use our policy tools to level the playing field. And for me, the things that are really important that we do not adequately invest in right now, that are very important for the future of Hawaii, are public preschool, which is expensive, and we are way behind the curve for compared to most other states. And the value of good quality public preschool is just so high for the life of a child and their economic prospects for life, but also the immediate economic prospects for a family who currently, if they are able to, are paying a lot of money to put their kids in private preschool. The other thing is that I think that is really important is to invest more in housing that people who live and work here can afford. Not necessarily what might be termed affordable housing, but having an investment in the kinds of housing that people need, because the market is not going to take care of that here in Hawaii. And so we need to be working on that. Maybe that could be paid for by counties with property taxes. Maybe the state needs to, but I think that those are two big ticket items that might require more investment now, but also, in my mind, will lead to growth for the state and the economy going forward. And if we don't do those things, we might continue to see the brain drain indefinitely. Aside from those things, I also am very interested in property taxes. At least being able to analyze what's been going on and make a statement about why we think they need to be adjusted. And I do know that previous tax review commissions have addressed that, and there's some data on how rates have changed over the years since the responsibility went to the counties. And the last thing on my list, and I don't feel all that strongly about it, but I do have an interest in trying to see how we can, whether there's a way to assess more revenue to visitors to support the costs that they bear for roads and parks and so forth. And I know that we already have the TAT. There has been proposed a green fee. If there is some mechanism that would help our visitors make this a better place for them to visit, I would be in support of that. That's my list.
So can I ask a question to clarify the first 2 points you made? So like those are spending programs, and our kind of reason for being is tax policy. So is that specific spending program supported by specific tax policy, or I mean, we're not, or are we talking about just increasing general fund revenue to be available for those types of initiatives?
Thank you for asking for that. I'm actually probably just thinking that we ought to increase general fund revenues, that would be necessary in order to meet those objectives. Not any particular means of doing that. So I'm open to whatever people might have. in mind for that. You know, you brought up the possibility of increasing the general excise tax, provided it remains progressive. I know that this is anathema to my organization, but I certainly think it's worth looking at, because the way the money could be invested would be extremely valuable to lower income households.
Chair, can I ask a question maybe for your CPAs or anybody else who has an opinion on Bill 56 has a conveyance tax proposal for properties over $2 million, I believe it is. Any comments?
I think it was over $4 million.
Okay.
And just, I was just going to note that SB 56 is probably dead because it got a quadruple referral. So it's probably not going to go anywhere. Yeah, and I don't know whether there's anything else with conveyance tax in it. Is that something that you think we ought to be looking at?
Oh, for sure. I've always, I mean, conveyance tax is a certificate that comes directly to our attention, even though the state doesn't pay much attention to it except collect the tax. The conveyance tax certificate is a form that was established by the Real Property Assessment Division when it was a state function, so that the state tax office, now the county tax office, knows where to send bills to. I don't think I get it. I mean, if you're going to pay more for a property, you probably have more money, or you'd be expected to pay more if you're going to make that transaction. I'm just wondering if that alone was a separate item that we had maybe could address or maybe suggest. Is that something that either Sale or Elton would have a comment on, if they had any objections or comment to that? No?
Yeah, I don't have objections to that. I think, I mean, it is part of the real property, increasing real property value. I mean, if you are going to make money off of a real estate transaction, and that is the desire of the state to make a bigger portion of that, then I mean, I don't have any technical objections to that.
Yeah, I'm not opposed to it, but I think the increase in tax is fairly substantial.
Oh, yeah.
So, we should probably carve out certain exceptions for, I don't know, long-time homeowners or the people that we need to take care of.
Actually, on the subject of exporting taxes and borrowing the conveyance tax idea that was just raised, I'd love to see the conveyance tax go way up on out-of-state purchases of real estate. Because, I mean, you guys have all heard the stories. All these new high rises are going up in Kaka'ako. You go there during COVID, or when the visitors aren't there, and almost all the windows are blacked out because they're all vacation rentals, they're not residents, and they bid up the price. So I think unless we can make houses more expensive for non-residents than for residents, the housing crisis will continue. There'll be no change, because the amount of people in the world that would like to have a place here is so much more than the amount of people that actually live here, that unless we can make it more expensive for out-of-state purchases of housing units, the housing crisis doesn't have a chance of being resolved, in my opinion. Sorry for the doom and gloom.
No, I like that comment. I guess my comment is, I believe you have the right to have a different rate per tier. I guess my question would be for an attorney to find out whether or not you can do what you said. I agree with what you're saying. I just don't know if you can have two
Under the Commerce Clause?
Whether or not a resident would pay this much, but if you're not a resident, you pay this much. I'm just wondering if that's allowable. That's
yeah, it's a good question. Might fall under the Commerce Clause.
Yeah, it's probably unconstitutional.
And I will say this: when you increase the conveyance tax, you incentivize somebody to form a corporation to buy the property, and then you just buy the shares of the corporation, and so you don't have to pay the conveyance tax. So the conveyance tax, you got to be careful, because it's one of those things where you're like, oh well, easy, we'll just raise taxes, and then all of a sudden you just have a bunch of corporations owning a bunch of real estate.
Right, just like Larry Ellison buying 98% of them.
Yeah.
Well, I'll just throw out there then, Seth, if you have any way that you're aware of to make it more expensive for a non-resident of Hawaii to buy a house or a housing unit in Hawaii than for a resident, I would love to hear about it. Whatever vehicle there is, if it exists,
Well, it is, and it's called property tax, right? So property tax, it increases the cost of ownership of a unused asset, right? So if you own a property and you're just sitting it, letting it sit there forever, and you're not benefiting it from it, and it still costs you a lot of money, that is generally how you do it. So New York City has really expensive properties that just sit there vacant for most of the time because they have lots of rich people who just charge a lot of money for it, right? And then they, like, the city says, okay, you get to be on Billionaires Row. Billionaires don't really live in New York City that much. And then they get to collect their, I don't know, whatever they charge for individual income tax, and they use that for other things, right? So that's generally how it works. You can't, Oahu has created the schedule resident A. So if you don't live here, you pay more in taxes, but I think the property tax is probably a better shot than the conveyance tax.
Fair
Because
enough.
conveyance tax taxes the transaction, and so you get all these weird things that people do to get around the transaction, whereas the property tax is the underlying asset.
Fair enough. Quick question on another subject, Seth. Some folks are talking about leveling the playing field and so forth, investing in Hawaii and so forth. And I know some of the previous tax review commissions were recommending stuff as extreme as letting companies write off investments completely in the first year to try to incentivize more investment. Refresh my memory, does Hawaii have some sort of accelerated depreciation allowance for corporate income?
No, we do not follow the
Yeah.
There's no makers?
federal. No.
I mean, bonus depreciation in the last Tax Cut and Job Act was not followed. I mean, that was a big disconnect between the federal and state income tax law.
Because in a lot of things, it seems like Hawaii state follows elements of the federal tax code pretty closely. I've been kind of surprised that we don't have makers here, accelerated cost recovery through accelerated depreciation as the federal does. Just a side comment.
It is now past 2 o'clock, and I'm wondering whether you want to continue. We can certainly have more conversation along these same lines next month. Murray, do you think that you could have somebody provide a presentation for us on carbon tax at the next meeting?
Sure, I can do that.
Okay, because I think that that is a new issue that none of us, or at least speaking for myself, I know very little about, and I think that that would be a good jumping off place to have a robust conversation.
Okay, yeah, I can do that.
Okay, is there anything else that we really need to cover today? If not, then it is 2:03 and our meeting is adjourned. We will see you in April.
Just a quick question for the date of, I think we should finalize the date for the next TRC meeting.
Oh, yeah.
It's, I am not available on the 21st on Wednesday at noon. Doesn't mean you can't have it, but.
Did we
Nor am I.
deal with that? I thought we found another date, but I could be wrong.
Oh, you're right. I have it April 15th. Is that what you guys have?
I don't.
I don't have it on my
I
calendar.
don't have it,
Okay, so yeah.
but I could do it April 15th.
It's tax day. It would be a great day for it.
Got moved
Was
back
it-
by a month.
Yeah, it was
yeah,
tax
extended
day
it.
as of yesterday.
Yeah.
Okay, why don't we plan to meet at noon on April 15th? And thank you very much. That was a good catch, Seth. Okay, so with that, we're adjourned. Thank you.
Thank you.
Thank you.
Okay, thank you.
Bye-bye, everybody.
Bye.
Bye all.
Bye.
All right.